Do you think there's too much money in venture?
Why are you building what you're building?
That we glorify venture capital too much in the headline. Oh my gosh, what a crazy valuation. This is unbelievable that they're able to raise this valuation. Maybe it was 1x preferred.
To what extent does the adoption rate of consumers accelerated by AI? If you get connected with one and receive capital from one, all of your problems are solved. You have no flexibility within a market that's going to start to be more turbulent. And to your point on COGS, right? Like, where are the ways that you might be able to lower them? Could you start to distribute something that's a different version of what you do that doesn't cost as much?
Hello, I'm your host, Mike Gelb, and this is a Consumer VC. We discuss the world of venture capital and wonderful consumer businesses. If you're enjoying the show, please subscribe on YouTube, Spotify, or whichever platform that you're viewing this content. And if you want the full experience, subscribe to my newsletter at theconsumervc.com. I send the latest consumer news and fundraisers in a jam-packed weekly email called the Consumer Roundup that you'll receive once you subscribe. And you'll receive new episodes as well straight to your inbox. All content and episodes are for informational and entertainment purposes only. It is not investment advice. Thank you, Taylor Foxman, for the intro to our guest today, Sid Banthiya. Sid is an investor and advisor to many consumer brands like Aeroflow, Holy, Splendid Spoon, and previously was a chief strategy officer at Milk Bar and the head of strategy and corporate development at Blue Apron. We're going to focus this episode on the two articles that Sid wrote, Avoiding the Road to Mediocrity and The Case for a Better Business Bureau for Investors. I would say this is one of our deeper episodes as we talk about human psychology, why to start a business, what progress really looks like, and term sheets. Thank you to our episode sponsor, Highbeam. Highbeam is the finance platform built for consumer brands. You can learn more at highbeam.co. Without further ado, here's Sid. Sid, thank you so much for joining me today. How are you?
I'm great. Great to be here, Mike. Thanks for having me.
Oh, thank you so much. It's an absolute pleasure to have you on the show. And thank you as well, Taylor, for the introduction. I know you've done a number of things in your career from being an investor, from being an operator. I wanted to start with as well these kind of two articles that you wrote. First of which is Avoiding the Road to Mediocrity. Can you give us a bit of the inspiration in terms of why you decided to write the article? And if there were companies or sectors that you were inspired by in order to really wanting to put your thoughts on a pad and start writing.
Yeah, it's interesting. You know, the motivation for it kind of came from a couple of different areas. One, over the course of my career, I've seen sectors where you just see a ton of capital that goes into that one sector, and then a number of businesses that are all funded. And it's happened in many sectors. I give the example I give in the article is about pet and pet food, right? And the number of different businesses that all got created at once. And the mediocrity part that I sort of draw the conclusion to, which is what I've seen, and it's happened in food, it's happened in beauty, it happened in personal care, it's happened in beverage, it's happened across sort of, I'd say, consumer, is there are so many businesses that get funded, and then there end up being people who are deciding on what they want to build in life, and they see where the capital's flowing, and then they decide, oh, that's interesting. If that's sort of the formula for being able to raise capital, maybe that's what I should be building. And on the other side, I've seen a lot of businesses that really don't care about where the capital is. And that side of the world has changed a lot, because I think that the ability to create a $20 million revenue business is much easier. And I say that with all humility, it's still really difficult, but much easier today than it was 10 to 15 years ago. And so those folks can have much less capital and then be able to build something where it's really based on where their observable sort of hypotheses are and where they see sort of cracks, inefficiencies, things that are actually pain points for them, and they're running after them because they think they can actually be great businesses too. I think those two things were in some ways the distinction I was trying to make. And it's a bit of a compliment to the folks that are out there that are founders, right? Like so many of them are so talented. And so part of what I wanted to instill was this question of why are you building what you're building?
Do you think on that front, when it comes to, your example of building, a $20 million business, which is incredible, especially obviously if it's bootstrap, but
Yeah.
do you think that we glorify venture capital too much? Are we part of the problem? Like is consumer VC part of the problem for glorifying it?
I think that's certainly a part of it. I mean, if you look at the headlines, right? I mean, the the vernacular, the word unicorn got introduced, right? And it got introduced in a way that was, this is an achievement and this is what we're all looking to do. And there were associated venture capital firms, right? And whenever you see the TechCrunch articles, the ones that come out, and basically all of the rags that are out there, you see X person got funded by Y VC firm to do Z, right? And and then you see on LinkedIn, and everybody's like, "Oh wow, that was great! Like congratulations, this is really wonderful." So I think there is sort of this element of positive reinforcement on being funded by venture, and that is an achievement in and of itself, relative to, I got a concept out in the market, I solved a problem, I made things easier for people, and people are just, from a customer perspective, super excited about what I've done, in the world of consumer, which I think is different than saying, "Hey, I got $20 million from General Catalyst."
Do you think this also changes a little bit of the mentality when it comes to being venture backed? Meaning, you might be less focused on revenue, for example. You're more focused on the fundraise.
I think that's right. I mean, I, first of all, fundraising is a full time job, and
100%.
I'm
And it has to
very,
be a CEO,
and
which
it
they're
has to be
doing, it has to be a CEO. You can't just delegate that.
absolutely, and I'm very sensitive to that. In fact, to some extent, I've made a career out of that idea, which is, hey, this is a full time job. You probably need someone to help you, with it, because you need to be really focused on the business, right? So yeah, I mean, I think that the focus on the fundraising part of it, and then once you have the funds, to your revenue question, you are you have funds, and so therefore you have the ability to go spend. Whereas when you don't, you're super focused on unit economics, right? Because you've got to keep, the ship afloat, and you got to do it in a way that works. Once you have cash in your account, you can start to take more risks, and that can be good and bad, right? Depending on what it is that the incentives are around you and how you're choosing to use that capital.
On that note, do you think there's too much money in venture?
It's a good question, and there's statistics around this, right, Mike? But
Mhm.
you think about sort of the last 10 years, what have been the highest performing asset classes? And ventures right up there, if not number one, probably close to number one in every single one of those years. So you can understand why any LP would say, I want to allocate more and more to this asset class that is achieving, right? But with that then comes more and more capital, which means you then, have more and more firms that are created. You have larger and larger funds, and you have more and more people who are out trying to deploy those funds. So I think it has gotten larger, and people have decided to take different takes on it. Right? It was a much smaller community, when I sort of got out of investment banking, or when I was in investment banking, than it is, today. And I think, but with any sort of proliferation, right, where you have more and more people stepping into a place that they otherwise wouldn't have stepped into, I think there are, things that come with that, and I think venture is sort of no different.
Yeah, I mean, I guess it kinda goes back to the article in that when there's a boom happening or a sector gets hot, right, then then there's a rush of people that want to get in. You could call that for venture when it comes to LPs. You can call that, what your article was originally talking about, which was building a company, right? And you actually just want to build a company in a specific sector because you see that there's a lot of maybe other companies doing it, and hey, it might be a little bit easier to raise capital here, and maybe that's the primary goal. When you talk to founders and you talk to operations, I know a lot of founders, probably speak to them daily, and and obviously you advise a lot of companies. Can you sense if the founder is actually building a company? If the company founder is building is truly innovative, rather than they're just kind of getting into this area because the sector is hot.
It's a good question. I suppose I think about it a little bit differently in the sense that when I'm talking to them, I can sense that they have different constituencies that they're trying to satisfy, right? They've got the constituency of like what's the vision of this business, the constituency of the employees, the constituency of the investors, right? Who have ideas of where they think the business of this founder should be over the next year or two. And I can sense, I think, that conflict in many instances where those incentives for those different constituencies around them are not necessarily aligned. And so that misalignment then sometimes leads to decision making that might be, to your point, less focused on innovation, more focused on market share. Pick a metric, right? But it may change the way that you operate the business as a result of where you're leaning on that sort of um, as you think about those different constituencies and who you're trying to satisfy.
Do you think you can course correct? A company can course correct if the reason why they maybe started the company was because wasn't really about innovation. It was more so, hey, I can build like this is a sector that I think is just really kind of interesting, but and investors think are interesting. So I'm gonna go and kind of build this company. And I come from maybe a business background, but you don't, but maybe you don't really have quite an edge that you need to. Do you think that you're able to kind of course correct if that's the reason why you started the company and still build like a successful business?
Um, I think that you are, but I think it's one of those things that require you to really dig into yourself for leadership, for the ability to see things, for trusting your gut, for being able to convince people that you may want to take a different direction. All of that, to some extent, is entrepreneurship, is leadership, and I think I'll give you an example just to make it a bit more concrete, right? I mean, back in the day, I was at Blue Apron. At Blue Apron, you could argue was a perfect example of everybody deciding meal kits was the next big thing, right? Blue Apron, HelloFresh, Hungryroot. I mean, there's so many of them, right? Purple
Right.
Carrot. I mean, all getting funded by venture, all coming in. So you can sort of argue, okay, so what happened to all those businesses? Which ones survived? Which ones didn't? And what was that pivot point, to your point, where it was sort of like, hey, I came into this for one reason, but then I decided to go a different direction and I found the ability to do that. Um, take Hungryroot. That is an interesting example in the sense that they are, to some extent, giving you an ability to be healthy by curating the products that are out there, and that wasn't the mission of the business, at least as I remember it back in the Blue Apron days. But at some point, Ben and his team, or the investors, sort of said, "Hey, uh, what about this? Because this seems to be happening. I think this could be really interesting." And look, I mean, Mike, I think a lot of that comes from a lot of different things. I mean, it comes from uh, your read on the consumer, which is, I think, that fundamentally for me is one of the things that differentiates consumer from all of the other areas to invest in. Right? Like you have a view on what people are going to do and why, and on behavior. And I think we saw this to some extent too at Blue Apron, and it was a bit of a fundamental question, which was like, do people like going to the grocery store or not, right? And we had a view that their that there was friction there. And then if we could provide you with meals, it would be easier for you. And I think to some extent, um, when you're curating effectively a grocery store for a lot of products that aren't in the grocery store, which to some extent is what Hungryroot is doing, they found that opportunity. They were able to merge those two ideas of we like grocery stores, but we can't find this stuff, and then layer on a bunch of things to make a business that's successful, both from a unit economic perspective and also from a consumer perspective at the end of the day.
So was the pivot, just so I understand, so for the pivot from Hungryroot, was that them going from being a supplier and actually producing their own meal kits to more of a
Yeah,
curator or like marketplace type model?
yeah. I mean, it was, and I didn't, full transparency. I didn't work there. I just understanding
Yeah. You
from
just
being in sort
you
of
just saw it from like from a competitive set.
from
Yeah.
a competitive perspective is they went down a different route from a lot of the things that we were doing at Blue Apron, which was um, creating meal kits, which means sourcing all of the food, putting them into a place that made sense, being able to create recipes on a weekly basis, then dealing with sort of all the permutations and combinations of how the fulfillment sort of equates with the software piece and being able to provide that to consumers, and doing it in a way where you can manage inventory of a perishable sort of nature versus what's happening now is they've got effectively a grocery store of healthy products and they're reselling them in many ways, but because it's specific and you get a lot of the information that you otherwise wouldn't get in terms of curation and being able to understand sort of the consumer and what they want. It's a different direction, and it certainly was a pain point. And I think that business probably evolved over time to what it is today. And I think that kind of thing can happen in any sector, right? You may start it for one reason, and then
Mhm.
be able to read what's happening with the consumers if you're really listening to them, manage the constituencies, and then start to move your way into a different direction.
Yeah. I mean, and also the Hungarian example makes sense on paper in that being a supplier, building these meal kits and actually doing all the work yourself, I mean, incredibly taxing,
Yeah.
incredibly tough. Where if you see yourself as like a destination more so, and you actually move like the curation model, I'd imagine it's a much better, or not better, but easier business model in some ways too. Um, how how do you with all this being said, how do you think someone should decide if they want to start a company? Or rather, if you were thinking about starting a company, what would be what how would you think about if this is something that you actually should pursue or not?
Yeah, I mean, for me, it's all about product market fit, and that product market fit in many ways comes from, and I think this is where a lot of the passion and energy and everything that you're going to need to create something comes from. Is it's something you see, and it's a pain point for you, and it's observable, and you can understand it. And every time you do X or Y, you experience that pain point, and chances are, if you're experiencing it, other people are too. And then you begin to think about a solution for it, find a fit for the solution that you have, which is the product market fit, and then see if you can develop the economics, the underlying economics that can make it successful. But I think it really starts with that sort of observable pain. And if you feel it yourself, the likelihood is that others do, which in the article I was trying to draw that distinction between that sort of philosophy in terms of starting a business and the philosophy of taking into account capital flows, which is not to say they shouldn't be taken account at all, but if it's sort of the only factor that you're considering, I that's the distinction I wanted to make.
When do you think it makes sense? Let's say you have, found a market fit, right? And you're the right person or you believe you're the right person that has the unique skill set to start a company in this particular market. And it's a deep pain point for you. When does it make sense to consider venture versus bootstrapping or even, maybe angel money, but it's quite different to, venture capital.
I think not everybody has access to capital in sort
Right.
of the bootstrap sense, right? There are people that have existing networks of friends, family, former colleagues, et cetera, that may be open to funding your business, and you can get uh, a certain extent, down the road by doing that. And there are other sources as well, right? And I think to the extent you can do that in order to find out the answer to the question, which is there there? I think you can try and do that on minimal capital. I was talking to a founder the other day that basically wants to do um, curated meat from very specific butchers at a very sort of uh, high end level, and he's doing it very geographically specific. He's trying to do 100 customers. He's planning on doing it for a certain amount of time and then figuring out whether there's a fit there. Do those people keep coming back? Is the feedback, he's going to do the deliveries himself? Or is the feedback, really great? Does it really make a difference in their lives? Are they finding it that it's economic? And which is a really big question today, right? Like markets are volatile, people seeing pullbacks in the consumer across income segments. But as you're doing it, like, are you seeing that traction that gives you the confidence that trying to expand it, scale it, makes sense? And I think you can do that with a smaller group of customers in order to get that sort of feedback up front before you decide that you need more money to scale.
Well, there's a kind of, I guess what's been said is, go slow and then go fast. I forget who kind of coined that, but
Yeah,
um, for you, for and also in this particular example, when does it make sense to actually start slow? I mean, CPG, for example, a lot of when I have a lot of investors on, a lot of what they say, and not to generalize, but kind of go slow in terms of being very specific about um, retail expansion, not kind of going too fast when it comes to retail, right? Which I've also had founders on the show that were actually went scaled retail very, very quickly.
yeah.
Um, how do you think about this as well when it comes to when it makes sense to actually go slow versus when it makes sense to actually go fast in building a company?
Yeah. Yeah. I mean, as it relates to, use the example of food again. There are different sales channels in which you can sell, right? Um, and, as an example, you could rent a kitchen. I mean, I'm here in New York. You could rent a kitchen, decide that you're going to start to, or frankly, create things out of your own house, sell them at farmers markets, and start to see if you're getting some level of traction. You can take that and then say, okay, I'm going to start selling this stuff online, right? And if you sell online and you sell out, your issue is you sold out, right? And there are people that wanted it and you could have gotten those sales, et cetera. If you sell out and you're in CPG and retail, right? And your partner, whether it's Whole Foods or Target or Walmart, et cetera, feels like you don't have the inventory to satisfy the demand that they're giving you shelf space for, it's a real problem in the relationship. So I think that's one of those examples where if you're going to have a partner in terms of the way your selling goes, as in this example, you don't want to create that friction with Walmart, right? Because they may have give you some shelf space this year and next year, and they may decide, look, we had this issue with them. We don't want to have a stock out such that we're not selling and optimizing our floor, right? Our plan. So I think that's an example of like, hey, if you're going to go into retail and you're going to pick a mass retailer, you you probably need to figure out your inventory, your ability to fulfill that demand, et cetera, under different scenarios before you decide you're going to go to whatever the number of stores are, 500 stores versus 100 stores. You know what I mean? Whereas if you want to go fast on the online side, so you can try and get more of that information, and in particular, customer information, which you get less of when you go into retail, you may want to go faster online, barring sort of the issues of performance marketing and some of the unit economic impacts of that. But it's probably from that perspective, from a channel diversification perspective, of places where you can go faster or slower depending on what you want to achieve.
Yeah, that's fair. And also on the retail side, really kind of understanding what those retailer relationships are as well. And, because if they lose interest or you're moving too fast, your velocities are too fast, you don't actually have the inventory to scale because you've actually expanded way too much on the retailer side, then that's also really bad. Even though it on the paper it looks great because you sold out, but at the same time, then the retailer can't. So the retailer will probably bring in like competitors to actually to expand the category. When you see or identify maybe a category is hot or there's a lot of investment in a particular category. Take, I don't know, take anything. Take like, crypto back, 2, 3 years ago, or even maybe AI right now. Um, I know that you mentioned pet as well, before as as an attractive category, or it could be even a theme. Like for example, I just came back from Expo West, and protein was a huge,
Yeah,
huge theme across a couple
supplements, right?
categories.
Yeah, and protein
Totally,
in particular. Yeah.
totally, totally. Does that, as an investor, when you start hearing that a company is hot, like people are just want to talk about it, does that actually make you want to cool off and say, you know what? I actually don't really want, like, maybe I'm too late here. Maybe I don't actually want to interested in this category, or a company really needs to wow me in order for me to get involved in this category. How do you typically think about that?
Yeah. I think on the one hand, when a lot of money goes to a particular category, let's call it supplements, right?
Sure.
The interesting thing about it is all those companies then begin to spend money. And in the area of supplements, and there's all kinds of things, there's protein, cholesterol, like, you name the number of different things that are out there these days, right? But those companies start spending on education, right? They start telling consumers what's the differentiation between what they're doing versus what other people are doing, and why it is that their company and you should be using their products versus others. And in a lot of ways, that ends up educating the market, right? People start to do and have access to more research and more information, and they become more familiar with a particular product or sector. So from that perspective, it's good, right? Because you're able to educate a market in a way that's much quicker than you would have if you were sort of one business within that sector. Um, but on the other hand, there's a valuation component to it. There's a competitive sort of component to it, and and then I'd say probably the last piece, which is just like what does that adoption curve really look like? And then what's the macro environment look like, right? I mean, today we've got a really interesting macro environment. And if you think about sort of, discretionary spend, that's probably one of the things that you think about versus something that's a little bit more essential. And what level of pricing power you might have in what might be um, a more risk averse sort of consumer sentiment time.
How then also do you think about price discipline when it comes to even investing in a company that might be in a hot category, and that you're like, like from your first, I guess, first example, if it is a hot category, they're spending companies are maybe spending a lot of money on consumer education. This is great, and kind of all tides lift up all boats type of environment. How, but at the same time, it might mean then that in hot categories, pr- uh, uh, the prices to actually invest might be a lot higher.
Yeah,
How does I've heard people say price discipline doesn't matter, although that was more so, I would say, like 2, 3 years ago.
yeah.
Now I think people have kind of scaled back. But how do you think as an investor about price discipline? Does it matter to you? How do you think about price?
Yeah, it absolutely matters to me. I mean, I was working with a business called Holy that's out of Germany that does sort of energy drinks, iced tea. Great business now, sort of pan European in terms of its operating footprint. And we talked about around, and I had talked to a few investors about just sort of considering the opportunity. And as they thought about valuation relative to what an exit might be, once you started getting into territory that was too high and you considered what the exit might be, the probability just started to get really low, you know? And even though it's an interesting business that's performing really, really well, once it hits a particular valuation and the requirement for the exit is too high, and you go back and look at all the precedents within consumer and say, what's happened? You'll find in the example of that company and many that get to a particular size, like how many billion-dollar exits have there been? And so if the business is starting to approach, I don't know, 400 million, 500 million, 300 million, you then start to say to yourself from a valuation perspective, hey, how much room do I have to achieve a return that I'm supposed to be achieving within the portfolio of the businesses that I have? And what's the probability that I achieve that, right? And at some point that starts to become less attractive, and the entry point has something to do with that, right?
Are there parts of the term sheet that you still think are undervalued or misunderstood today?
Yeah. um, I think in general the waterfall, right? Liquidation preference. What are the terms at which a new investor on an exit, what do they get? What sort of preferred shares do they have? Are they participating? Are they not? Do they have liquidation preference, et cetera? I think for many people working at a company, which is to say employees, executives, I think many of them, uh, I think, don't necessarily appreciate the full extent of what those terms might mean for their own equity. And I think that happens at lots of businesses, and through no fault of their own, simply because it hasn't been one of the things that they're focused on. But I do think it's one of the areas within term sheets that don't get enough attention, because I think people, going back to one of the comments you made, Mike, which is what we put in the media around what was the valuation, right? Who was the investor that was associated with that, and what was the amount of money that you raised? Well, from a waterfall perspective, like all of that could be terrible, right? I meaning from the perspective of, let's assume you think you're going to have a $250 million exit, okay, and you've got 50 million in debt. Well, from a waterfall perspective, that debt's going to get paid first, okay, and let's say you raise $50 million, right? And it's a 3x liquidation preference. That's another 150 million that's going to get paid out to that pref investor before anything that gets to the rest of the pref investors, which then after that gets to common, right? So you may be sitting there with looking at your equity that you got and say, okay, I came in at 50 million bucks. We're now getting sold at 250. So whatever the equity I have is, I can multiply it by 5 or whatever, or take out the 50. And it's actually not true when you take into account the waterfall, because most of that value has already been distributed to the folks on the waterfall that, from a prioritization perspective, are going to be receiving that first.
Yeah, totally I totally agree with you, because sometimes I feel like in the headlines, it's like, "Oh my gosh, what a crazy valuation. This is unbelievable, like, that they're able to raise this valuation." But what you don't know, and maybe it was 1x preferred, or maybe just 1x, but it might have been 3x.
Yeah,
It might have been above that 1x. And it's almost like they're actually getting, unless you really just have a phenomenal exit, which I hope you have a phenomenal exit,
yeah,
the company. But it's almost like 3x times they actually own, 3x more of the company, than they actually do.
that's right.
Um, and because I remember talking to one investor, and he was saying that his previous firm, they did a deal that was crazy, like a huge valuation. They would never ever agree to this deal, but as 3x preferred, they're like, no problem, we'll do it anytime. So, well, not anytime, but they will do in that situation. And that is deceiving because you look at, okay, what's the percentage the investor owns and everything like that. But actually, it could be a lot more and a lot more devastating to the founder than you actually think. Obviously, it takes both sides to agree to a deal. So it's also the founder. It's also the founder as well that's agreeing to this too. Do you do you not think though it's great behavior for investors to kind of behave that way when it comes to 3x preference?
Yeah, it's a good question. I think that um, there are reasons to do it. As an example, some folks that are putting in those types of terms are already invested in the business, and they may have invested at a time where the valuation was very high. They didn't have a liquidation preference, and therefore they put in more money than they expected and have very little equity. And in some cases, are trying to make up for the fact that they had little equity before, and they're trying to cover themselves in the future for what they still think is a really interesting business, right? And so they're trying to figure out their own uh, um, portfolio management and how this fits within sort of the broader return profile that they're trying to achieve, right? And I can understand that. I mean, at the end of the day, right, Mike, like that's the math. That's the job that they have. That's what they've been given capital by LPs to do, and they're trying to achieve it. So that's their perspective, and I think it's simply the job of the founder as a representative of the common shareholders to understand that that might be the motivation of what they're doing relative to what the common holder is expecting, right? And I think that's just important for them to sort of take into consideration. I think part of their responsibility set.
Yeah, and I mean, I think it's also interesting too. And again, it takes two to tango of
Yeah,
of of
yeah,
of all these things.
totally.
So at the same time, founders have to understand, and there can't be kind of like excuses down the line. This is what the terms are agreed with. So, but I do think it's interesting. I remember talking to an investment banker about how M&A transactions were getting held up because the investors had the 3x preferred, and the investors like, oh, let's get this deal done, this is great. But then the founder would block the transaction because they would be left with nothing or very little. So why would they actually do it? And so it can, that type, this liquidation preferences, it really can set yourself up to really have to be thoughtful in terms of what that should be in the negotiation side, because what the exit is, which is beneficial to everyone having an exit, everyone that's on there, as long as it's a successful exit. But the but it could end up blocking deals that actually could have get done, if it wasn't for this preference. But at the same time, would the investor have made the deal if it wasn't to be expert preference? So anyway,
Yeah, exactly. And I think that's just one of the reasons that, and one of the comments I make in the article, the Better Business Bureau article, is just lay out the scenarios. Like let it be transparent for everybody. Go to the board, use the folks around you that are super helpful, your lawyers, your bankers, assuming that you have one, and lay out what exits look like, different exits for different constituencies in the waterfall, so that you're all sort of super transparent about it, right? And everybody sort of understands, if we don't hit X, common is not in a great position, and what's the probability of that exit versus a different exit, right? And that way, at a minimum, you're going in sort of eyes wide open of what does this all mean for everybody. And then you sort of do some of the operating and business planning around that. But the reason I think it's important to sort of both socialize that with your board, but also socialize that with your executive team, is because your executive team at the end of the day are all operators, and they know they're going to be tasked with being able to achieve that growth, or being able to achieve that margin expansion, or being able to get that market share gain. And they have a really good relationship with what's the business doing? What's the adoption of customers look like? And is that achievable? And that a little bit goes into the budgeting process, right? Like, like CFOs, CEOs, like the execs are sitting around, they do these budget processes, they get input from everyone around the table that's managing a department who sort of says, hey, I can do this with this budget and I can do that with a different budget, right? And you take all that into consideration and then you ultimately come up with a budget. But I think that socialization and sort of ability to get all that input um, is really helpful in terms of trying to find that common ground. To your point on it takes two, right? Like, where is that common ground between both sides?
Well, I'm really glad you brought that up. I'm really glad that you brought up the other article they wrote, which I really enjoyed also reading, the case for a better business bureau for investors, where you talk a little bit about how investors are some investors have been bad actors in terms of how they respond, which is shocking to me that investors would be bad actors. But I'm just kidding. But what was the inspiration from to actually compose this article?
Yeah. I think part of it was really sort of living through some of these exercises where you're going through the cap table and then finding out, what at the end of the day was put into a term sheet that many of the founders or execs just didn't realize. And then as they go through sort of the cap table and what might happen at an exit, they sort of then begin to realize what all of those things actually meant. Um, and obviously, investors are very well versed in those terms. And I think to some extent, um, there are lots of founders and execs and employees in general that are not. And so what I thought about was, whenever customers back in the day, right, felt like you were at your local, company to go, I don't know, like rent a lawnmower, right? And you realized that the guy was completely gouging you when you found out from your friend that they had rented the same lawnmower like, 3 months earlier for half the price. And you sort of said to yourself, wait a minute, like why did this happen? And I remember talking to my parents about the Better Business Bureau way back in the day, where you could go and find out about local businesses around you and what sort of their reputations look like. And so I thought to myself, with that asymmetry, right, of what sort of founders and execs know versus what investors know, wouldn't it be great if there was something similar where you could find out about how the same investor that you're trying to go get money from treated the rest of their portfolio companies, and not just the ones that they suggest you to go speak with, but everybody. And then it was done sort of an independent, way where you could actually find out more information about them too. And I think it would sort of serve both parties, right? Like great investors who treat and are transparent with all of their companies, that would come out in a Better Business Bureau just like bad actors would.
How many investors do you think, or percentage of investors you think actually add true value to companies?
Yeah, I mean, look, I don't know a percentage. I will say from my own experience that the ones that have real operating experience can really provide input that's really valuable. And in the cases where they don't, um, they've seen very similar sort of patterns in the past that they might be able to pass along as, here's some case studies and what we've seen, and let's sort of think about that as a potential outcome because it happened. Um, but I think the ones that have real operating experience have a bit of a pulse, particularly in consumer, a bit of a pulse on how things might play out, and I think that's really valuable.
Do you think, or where have you seen career investors that don't have operating experience, how that well, first of all, can they add value, and if so, where do you feel like that value typically comes from?
Yeah, I mean, sure, I think they can absolutely add value. I mean, I think um, even without operating experience, you may have uh, relationships with strategics, right? You may know all of the potential strategics that a business may be sold to and have good relationships with them, right? And be that source of, hey, what are they looking for at the moment? Why? And how does that align with what we're building as a business if that's the ultimate outcome that we're thinking about, right? That's a way. You may be a firm or a group or a person that's just very well connected from a talent perspective, right? You just happen to know lots of great marketers. You happen to know lots of great, supply chain folks. Sort of product people. That could be super valuable. I think there's tons of ways that you can be valuable, even if you're not an operator. I just know from my own experience that sort of operating experience really comes in handy when you have those sort of challenges and pivots that you're thinking about in the business. Um, because typically it comes from having uh, made those decisions in the past and seen how the outcomes play out, and actually being able to look and feel and understand it from having done it.
Sid, I want to do a rapid fire round. Are you game?
I'm game.
All right. What is the biggest consumer trend to watch out this year?
The biggest trend from my perspective that I think is kind of interesting, and maybe I'll go back to supplements as just sort of an example, is to what extent does the adoption rate of consumers within a particular sector, which is to say, how quickly do they decide they want something? To what extent is that accelerated by um, AI? I think that's a really interesting question because it's one of those things within consumer that I always find is an unknown. And by experience, it's people that have done that before and seen what works with consumers, like have a bit of a pulse on it. And that's what I was sort of referring to. But to what extent is that influenced by the button on the right on your phone, right? Where you sort of say, hey, explain to me what colostrum was again. Like, why am I taking this? And you have this button that goes out and finds all of this information. Does that type of thing really begin to facilitate adoption differently than perhaps it was in the past? And there are probably much more broad ways of thinking about it, but I think that trend of how quickly or how different is it, or do adoption rates sort of change over time based on AI can be really interesting.
Yeah, I think that's really interesting. I'm also very, very interested as well from the back end of side of what actually happens with content.
Yeah,
Because if we're now using AI, like in your particular example, and it scours the internet and it finds you the answer, you're never going to actually where that publisher published that article or where it actually gathered that the actual source there. And I do wonder when it comes to content if we're going to see kind of content becomes devalued or deteriorate because you're not really incentivized as much to actually produce new content if you're actually never able to actually get that kind of click attribution back to what you actually wrote. So I'm also kind of interested to see what that
yeah.
actually relationship is as well between AI and the actual publishers too. But yes, I think that's a really really cool trend. Um, what what consumer category are you most bearish on?
Um, yeah, it's a good question. I mean, I would probably say just given the volatility out there in terms of the markets, a bit of the consumer kind of pullback in general, and I'd say this might apply across consumer sectors, is any place where you see there's a lack of flexibility around pricing. Um, I think is probably a place that I'd be bearish at the moment. I mean, if you're selling a discretionary product where on a relative basis in terms of your competitors your pricing is high and from a unit economic perspective it's hard to lower it, I think you may want to think about your forecast for the year and what sort of consumption might look like relative to those things. You may want to think about diversifying both in terms of channel, right? Like if you're a single channel, imagine you're sort of a single channel e-commerce business and you're selling a powder that's really expensive for you to make. And we're getting into this sort of cycle, at least what it looks like today, this consumer cycle that we're about to enter in. I would be really bearish on what the forecast might look like for you. And I think that goes across, though, Mike. I mean, that probably goes across everything from beverage to food to personal care to beauty. Is if you're in that situation, I think you should, as you think about, budgeting for the year, it should be something that you're focused on.
So if you're selling a premium product, you don't have flexibility when it comes to your pricing. Looking at a product company, for example, maybe your cogs are just high, and there's no way to actually bring them down. You also maybe the tariffs don't help you either that are coming. That those are the types of if it's too premium, then you're out.
Yeah, I don't know that I'd necessarily describe it as, too premium versus not, right? Because if you have a really interesting product, there's always going to be a high income segment, out there. So if you have a
Yeah.
super differentiated product, but I just mean if you have no flexibility within a market that's going to start to be more turbulent, right? And to your point on COGS, right? Like, where are the ways that you might be able to lower them? Could you start to distribute something that's a different version of what you do that doesn't cost as much? Like, have a more conventional sort of offering from what the premium offering is to sort of supplement? Can you move into a different, channel, which in some cases will require you to have sort of different pricing, and so therefore put out a different, kind of product? Like, if you have flexibility around those sorts of things, and it doesn't take you 6 to 9 months to be able to do it, then you're probably, you've got a little bit more insulation, and you've got a few more levers that you can pull. And if you don't, then I'd be thinking about it.
What's your favorite consumer product innovation in the last 5 years?
I'm just going to take the business that I invested in most recently, which was Airflow, and I really love that business. Because one, I love the founders. Two, I just thought it was such an elegant design. And for those folks that are out there, it's effectively a bottle, a water bottle, where there's a cap and you can push a button and carbonate it. And that's what they do. And I just it's sort of the modern version of SodaStream, which obviously did really well from an exit perspective, except it's portable and it can be used on any water bottle. And I think it's great.
Yeah, looks like a super, super cool product. Within venture, what's the biggest thing you've changed your mind about?
Yeah, I think the biggest thing I've changed uh, my mind about in general is how much you need it. Um, because, uh, and I'm sure you remember this, Mike, but when a lot of these businesses that were coming out that were e-com businesses, regardless of sector within consumer, right? Many of them they had huge groups of software engineers that were coming up with how it was that they were going to sell. I mean, when we were at Blue Apron, that was the case, right? Like, you didn't have an out of the box system like Shopify, right? You weren't able to put together. You didn't have, like, Klaviyo and all these sort of different um, opportunities out there, and to be able to really just put up a business with minimal capital that you do today, right? And so in many ways, I think that's one of the things that I've really thought about more and more over time is, to what extent in so many of these sectors can you put up a business without having to take venture, at least initially, right? And then be able to go out and do some product market fit work, and then have the ability to actually sell product, and to the extent that you need to preserve the equity that you've worked so hard to build, from a business perspective, because many of the things that originally were a lot more expensive and required capital require a little bit less.
No, that's a really great point in terms of just the whole cycle in terms of how where we're at. Definitely remember those moments. What's the biggest myth about venture capital?
I think it maybe goes back to what we were talking about, um, as it relates to how they're kind of portrayed in the media, meaning that if you get connected with one and receive capital from one, all of your problems are solved. um, it's which, people that are founders and that are execs on teams, like, no, that's not the case, right? I mean, it's obviously a component of what it is that can help you execute, because you now have capital, and you're connected to a support group to some extent. But it doesn't solve all of your problems. Most of them are still there, and that's the hard part about entrepreneurship, right? And it's also the fun part, like figuring it out as you go, and tackling those one at a time.
What's one book that's inspired you personally and one book that's inspired you professionally?
Yeah. And I know you always do this question. So I was thinking about sort of the books that I've read recently. And I would say, interestingly, one of the ones that I've been, it's really impacted me, and it's actually professionally, is a book called Kingmaker. And it's about a woman named Pamela Harriman, who was born in the UK, and at a time where there were lots of barriers to what she wanted to do, which was become a political force in the world. And she found so many different ways of sort of getting around those barriers, many of which we're trying to continue to break today. But I found it fascinating to hear about all the different paths she took, to be able to ultimately put her in a position where she was a power player. And she was a power player her entire life, but considering the circumstances, it's just really impressive. And so professionally, it sort of, taught me that, you may think there's lots of barriers out there, but there are lots of ways around them. And there are many people who have had much bigger ones than we do today, in the past, that have found a way. So yeah, and it's a really interesting one historically as well for people that love history. The other one I'd say is Knife, which Salman Rushdie wrote, and it was about his experience, ironically, coming to the U.S. and talking about writers and freedom of expression. And as he was talking about it, he was attacked. And so he talks about his experience. And at the end of the day, what became most important to him after having lived through that, which was continuing to write, which he bravely continued to do after being attacked, and love, family, and his partner, and all of that. And I thought that was personally just an inspiring book in terms of how he handled all of that.
Yeah, totally. I will have to read it. I can't imagine what just lecturing about free speech and then that incident happened.
Yeah.
Quite unbelievable. Sid, this has been an absolute pleasure. Thank you so much for your time. I really appreciate it.
Of course. It's been a pleasure for me as well.
And there you have it. It was a pleasure having Sid on. Sid, thanks so much for coming on the show. Highbeam, thank you so much for being our presenting sponsor. Highbeam is a finance platform built for consumer brands. Check out Highbeam at highbeam.co. And if you're loving the show, subscribe to the newsletter. Go to theconsumervc.com, click subscribe. You'll receive a weekly email of all the consumer deals that are happening, and you'll be the first to know when a new episode drops. Thanks for listening.